Hello and welcome to Vox Markets. I am John Hewitt. I'm delighted to be joined once again by Jamie Constable of Singer for our macro monthly roundup. How are you doing, Jamie?
I'm good, thank you. Certainly been
Excellent.
a lot of macro going on.
There really has. And we did say last month that, everything could turn and turn again. And it really has turned this month. I guess the
Mhm.
obvious place to start is what's been going on in the banking sector.
Yes, well, I mean, no one expected anything that's happened in the last month. Obviously, we kicked off with Silicon Valley Bank in the States. I suppose how we summarize that is management failure more than anything else, to be
Mm.
perfectly honest. I mean, they thought they were in nice, safe treasuries, mortgage-backed securities, and of course, they didn't match. They didn't hedge it out, so as those interest rates went up from the Fed, they ended up with a big liability mismatch, and we all know what happened next. And now, actually, today, they've been bought out basically by just the First Citizens Bank in the US. They bought the assets basically. So yeah, that obviously started everything. And from there, we've moved on, haven't we, to the next one, which was Credit Suisse. And I suppose what we're seeing here is people are identifying banks that have been weak historically, and then saying, well, maybe not SVB, and then having a go at them. So Credit Suisse, if you look at the long-term chart for Credit Suisse, it's gone from bad to worse really over the last 10 years. And they were targeted. And we all know, the one thing we all know about banks is they're all safe until they're not. And if a bank sees a run on its deposits, they can't. There's not a lot they can do if you if you have that crisis of confidence. And Credit Suisse, by all accounts, according to the Swiss over the weekend, said that they wouldn't have lasted another day.
Mm.
So they end up in the hands of UBS.
Yeah, so it has sort of reminiscent of some things that happened during the banking crisis
Mm,
before, for the great banking crisis, 2008. That
yeah.
said, I think the general view, and I wonder if you agree with this, is that the risk of contagion as it was then is much, much slimmer.
I think that is the bottom line. I mean, just to finish on who they were targeting, they tried to target Deutsche Bank on Friday, but the bottom line on Deutsche Bank, and let's be clear, the bottom line on banks in general is that the balance sheets are much better than they were back in 2008, and that's the big difference this time round, particularly for those banks seen as systemically important, the top 30 in the world, or 29 now because Credit Suisse is part of UBS, but they are extremely strong balance sheets now. So we shouldn't see contagion happening. And that's the key thing now. And it would be really strange, if you have a crisis, you don't normally get the same thing causing the next crisis. Let's be honest, because people have identified that problem, and it's something left field that causes problems normally, rather than the same problem you had before. So yeah, we've had Deutsche Bank identified. They've come out very strongly over the weekend. And let's be honest, no bank went bust over the weekend, which was quite nice, really. So hopefully we can return to a bit more stability now, and we can focus back in on what's happening in economies and for earnings for companies.
Mm, mm. Before we come on to that, I guess
Mm,
one of the main reasons why this all kicks off, this sort of mini banking crisis that we've had, is essentially a result of rising interest rates.
yeah.
Particularly in the case of SVB and its
Mm,
bond portfolio. And there was a lot of speculation, after or as this was happening over the last couple of weeks, that this would mean the Fed has broken something and has to
yeah,
take its foot off the pedal, but it didn't.
it didn't. No, you're
So
quite right. Nor, and neither did the ECB.
So why do you think that the central
Mm.
banks are more worried about? Well, I guess they're more worried about inflation than they are about let's say breaking small banks. But is there more that could break?
I think partly we got to the stage. Well, ECB went first with their 50 basis points, and then we had obviously the Fed and then the Bank of England with 25 each. I think that partly it got to the stage of, look, we can raise rates because the system is stable. So you had that kind of counterintuitive. We can raise rates because everything's okay. And if they hadn't raised rates, people might have gone, well, hang on, they haven't raised rates. There's another problem hidden there
Mm,
somewhere. What did we miss? So that was part of it. And I think maybe most of it, to be perfectly honest, that they did that. Remember, with the ECB, they've been playing catch up. I mean, they've got to 3% now, whereas in the UK we're at what, 4.25 now, and in the US we're at 5. So the ECB started late and have been playing catch up. So I don't think their 50 was too much of a surprise. I think that really where we are now, well, personally, I think that there's rate rises one too far, maybe even too far in the UK and the US, because we're certainly seeing that the consumer, which is somewhat strange, and I'm sure we'll come on to a bit later, economies are pretty weak. If you look at the PMIs, the flash PMIs that have come out on manufacturing, we've spoken about before, they continue to show contraction going on. But the flip side is that services seems to be relatively strong. So that is partly why I think they did raise rates. That, and of course, as you say, the inflationary outlook, where we are seeing inflation fall in the States. CPI is back to 6 in the States now. We had that number in the UK last month, just out the other week, which was a bit of a surprise at 10.4. But if we look at forecasts going through the rest of this year, number one, we didn't expect it to start falling until Q2 anyway. And if you look at the forecasts, the April number announced in May for CPI in the UK could well have a 7 in front of it. So that's 300 basis points off where we are at the moment. And then forecasts for Q4, there's a few outliers in the high fours. But again, that's a massive fall from where we are now. But the OBR forecast that came out with the budget was for 2.9 at the end of the year. Now, if you think about when they made that forecast of 2.9, that was before we had SVB going bust, before we had Credit Suisse being taken over by UBS, and before the impact of those changes on the banking system, which is something we should probably explore as well, because let's be clear, if you go into a bank today, as opposed to a bank a month ago, the rate they're going to offer you as a corporate and the amount they're probably going to offer you is going to be less than it was then. So that has a contractionary impact on that will have a contraction. The rate will be higher, the rate will be higher, the amount will be less. So that has a contractionary impact on the economy. So what would that do for CPI? Well, that CPI 2.9 forecast that we had before from the OBR, you would expect to be lower now. So yeah, I think that they've gone plenty far enough, but that rate rise was really that everything is okay, which is within the financial system. That was the message they were trying to send out.
Yeah. But everything is not necessarily okay within the economy, as you've alluded to. So we do still have this kind of really contradictory, conflicting data.
Yeah.
In the UK, we had stronger than expected retail sales, which the jobs market is still buoyant.
Yeah.
And we seem, both in the UK and US, to be sort of skirting around recession. Do you think the risks of recession have now risen, up a notch, particularly given that this last round of rate increases?
I think the rate rises do increase the risk, obviously. I think in the States, you've got this really interesting position because you've had an economy there that has been pretty not dependent, but a lot of the growth's come through from tech and from loss-making, revenue-driven tech businesses. SVB was meant to have lent money to be a bank or a lender to half of those businesses in the States, which is a huge number. Now, with SVB going and that whole ecosystem under threat, I think that has quite an impact on the US. And at the same time, we've seen the big tech companies laying off tens of thousands of people. Now, to be fair, they geared up and now they're coming back again in terms of number of people. But I think in the US, you've got a question mark now about that whole tech-driven, VC-driven, loss-making, business-driven ecosystem, particularly now that money does have a cost, the end of free money. And as we said a minute ago, 5% on US rates. So I think over in the US, you've got quite a question being asked there. The UK, of course, we've not had that kind of driver for the economy. And as you say, the data been coming out of the UK has been a lot better than expected. Certainly a lot better than we expected at the beginning of the year. And that's been led by the services side of the economy. The flash PMIs last week came up a little in the UK, not quite as buoyant as the overseas ones, but still showing reasonable growth. Whereas on the manufacturing side of the economy, which to be fair is only 10% of the UK economy, but we're showing as akin to the rest of the world, a strong contraction. Now, if you push rates too far, you increase the risk of recession. But yeah, it has confounded commentators and me as well, how strong the consumer has been this year. But we did talk last time, didn't we, about the kind of wealth effect of the rate rises. And in an aging population, which is certainly what we've got in the UK, those people with savings have gone from getting 0 on them to now they can get 4% plus.
Lucky them.
Lucky them, yeah. Yeah.
I mean,
and mortgage rates have peaked. If you think about where we've come from in terms of consumer sentiment, we've come from autumn last year when we had the mini budget and the crisis from that, and people sitting there going, oh my God, how high are interest rates going to go? Can I afford my mortgage? To mortgage rates having peaked and now they're coming back down again. Yeah. So it's a bit better. It's better than it was. I think that's what we can say.
Yeah, I mean, I still have this feeling that you know, a lot of the strength we're seeing in services might be that sort of last hurrah. You know, the final bit of spending, because you know that what's around the corner may not be very pleasant, and you're desperate for a holiday. But you know, there's some figures out from the ONS this week. You know, household borrowing, you know, is huge. It's hit a record level. It's something like, you know, exceeded two trillion for the first time. You know, is a lot of this spending being driven by credit? And if we're seeing a credit contraction potentially, you know, is that potentially going to take the wind out of the sails of the consumer?
Well, credit has certainly picked up back to those kind of levels, you know, it was at before. That certainly happened, credit card spending. And that's not a surprise, I suppose. That's why we were thinking that the consumer wouldn't be quite, you know, had they got that money. And what's been very difficult to judge is that money that was saved during the pandemic, when people effectively locked down for a couple of years, didn't go on holidays, etc. How much money did people save from that? So that some of that money is coming back, and then you combine that with Paul Dora was just talking about, that people are now getting a return on their savings. That's obviously helping the consumer. I suppose the other point that you made yourself there, you know, you've got 1.1 million vacancies out there. People aren't worried about losing their jobs. Okay, the cost of servicing your mortgage has gone up. If you've had to remortgage, as it were, and that's going to be spread out through this year, that whole kind of remortgaging, and there are quite a lot of those. But the cost of servicing a mortgage is not up towards the extremes that we've seen historically. Okay, it's gone up, but it's not at levels of disposable income for the consumer that's really that has caused problems historically. So when we add all that lot up, it's probably why the consumer's feeling okay. The one thing that would kill it would be job losses. It's the same thing that kills the housing market. It's job losses, and people can't afford to pay their mortgage, so they hand the keys back and whatever. That's what really kills confidence. But yeah, the consumers, as long as people have still got jobs, and there is the chance of getting another job if you were to lose your job, I think people are feeling okay. But you're quite right to say that we do need to keep a very close eye on personal credit and the lending that's going on there, because that has picked up, but lending on credit cards. But you know, let's just go on to what's happened. What's, you know, one of the big drains on people's disposable income is energy. And what the government have done, they've extended the support scheme for an extra 3 months. And when that's out, we'll get the next review then in terms of of energy prices. But what we will see then, the wholesale price should be absolutely motoring back down by then. I mean, if you look at Europe, and the UK is very similar, the cost of gas there was 300 euros per megawatt hour. It's now, it peaked at 300. It's now back to about 40. And before and pre-Ukraine, it was around high 20s, 28, 29, around this time of the year. So that has come back up a hell of a long way. So we should see, and 70% of the increase in CPI has come from energy. We'll see that CPI come screaming back. The energy prices will come back from the consumer. So as I like to say, the delta is the difference. The delta for the consumer going for the rest of this year is actually starting to look quite a lot better rather than worse.
I mean, we had a budget in the UK as well. Did you? Was there anything you took away from it? There was some big changes, sort of the personal tax regime, particularly around pension saving. You know, which some dismissed as sort of a giveaway for the already rich. But was there anything that you noted in the budget that you thought was potentially good news for the economy, the kind of medicine that we need?
Yeah, we need a long-term plan for the UK economy. We all know it, and commentators are saying it, and they're making noises about doing that, and that they're going to come out with a long-term plan. But what we need is, as an economy, is we need to decide which areas we're going to concentrate on and which areas we're good at to grow the economy looking forward. And to be honest, there wasn't anything of that really in the budget. I suppose the big thing with the budget was that they extended the freeze on income tax allowances for another couple of years. So just dragging more and more people into that higher rate.
Fiscal drag.
Yeah, drag. And it's huge. I mean, it's a huge amount. And we're moving more towards a tax take from the UK economy akin to what you've seen in overseas in some of the European economies, rather than what we've historically had in the UK. And I suppose that is part of an aging population. It costs you more. You've got the NHS and all of that. But what we need to do as a nation, and I don't think it really was in this budget. Okay, we had the pension changes, but you're quite right. It doesn't make much change for anybody really. And then of course, you're trying to keep, part of that was to try and keep the doctors in jobs. But then if the opposition come out and say we're going to reverse it as soon as we get back into power, it could have a complete perverse effect of everyone retiring next year before the election. So it's, it does actually it's quite worrying really in terms of the longest term savings plan you're going to have as an individual, which is your pension. It seemed to flip flop backwards and forwards, because if we think back a few years ago, you could cap your pension scheme at 1.8 million. Then they didn't index it, and they didn't index that, but actually they did the opposite. They cut it to it was just above 1 million for the fund, which of course doesn't affect most people. But then now they've removed it totally, and then it might come back in again. So how can you do that in the longest term savings plan you're going to have as an individual, and instill confidence in the consumer to save for their retirement? Is quite crazy really at the end of the day to do that. So again, that's part of having a long-term plan for the UK economy, isn't it? That whichever political party it is agrees that actually this is in the interest of the country to promote stability there and to promote areas that we can win in. So that's what I'm looking for to come from government, and hopefully they can come out with something over the next 12 months ahead of an election.
Yeah, I mean, there was a very sort of high-level discussion of the sort of 5 key sectors that the UK should be involved. Green tech, AI, that sort of thing. But we really, I've been looking at this week that they've got to respond to the Inflation Reduction Act in a way that Europe has started to respond as well.
They're getting a new chip plant, aren't they? And we're not. I mean, the big new 2 new chip plants in the world are going, one into the US and one's going into Europe, isn't it? So
no, I mean it is a difficult thing for the UK as a kind of a smaller economy to have to deal with. But I completely agree. I mean, those sort of chip plants, we talked about these before. These are the kind of things that governments want to attract. Big infrastructure projects like that as part of sort of changing geopolitics and sort of changing global trade dynamics. But we don't seem to be getting them. But what has worked? We spoke about infrastructure before. The market's been funny this year, but what has worked? I mean, has infrastructure paid off?
I think in terms of sectors and looking at that, we're very bullish. We're bullish on capital investment driven companies, the industrials and things, and they've been coming out with some very good numbers. If you look at the Bodycote had numbers the other week, you read through those, they're seeing it generally in the industrial space with this reshoring, nearshoring, with, as we've spoken about historically, the lack of investment that free money drove globally, then those companies have tended to do quite well. So that's worked quite well. Elsewhere, equities, strangely enough, equities have worked as almost as the stable asset class, where bonds have gone absolutely all over the place. I mean, yields are just jumping up, down, all around, obviously driven by what we've seen from the banks as well. Sorry, you're going to go on.
Yeah, it's quite interesting. The bond thing, I think, is noteworthy. I was reading something the other day that said, the problem that we face as investors at the moment, particularly when deciding how to allocate across asset classes, is that inflation, if it were high and steady, it might be easier than what it's doing at the moment, i.e. inflation volatility, where it's whipsawing around and it makes it very hard to position.
Yeah, Yeah.
Is that something you agree with as a house, I guess?
I think people are finding, I mean, it's interesting because when rates hit their highs, they were becoming, particularly in the States, they were becoming quite a competition for equities. Then they've come off again, of course, and you had a bit of a flight to safety with SVB going bust. Today, I mean, every day is very volatile at the moment. Today, you've got rates going back up again, yields going back up again, because people feel that, you know, no bank went bust over the weekend. Maybe we were wrong about Deutsche Bank, etc. They're okay, and I think they are okay. So just add on that. So yields go back up again, but equities have come off the top, but they seem to be quite stable, which is strange, because if we're talking about a potential for a recession going up, particularly in the States, then you'd think that people would be more worried about company earnings. But you know, companies in general, and we've just been going through the results season, particularly for the mid and small cap companies, companies are maintaining their guidance for this year. And what I think, as commentators and economists and what people are, it's proving very hard to judge what happens when you stop the global economy dead and then you restart it again. And then you've had this huge inflation boost. Is it just transient, or is it now getting into the economy? Are wages going to go up and then come back and then fall back down again? It's very, very difficult to judge what's happened from that stop-start that we've had. And I think that's what that's what everyone's struggling with at the moment. So within that, you have to look for, I think, the secular growth areas of the economy, the areas where people do need to invest, hence infrastructure that we've mentioned before, the geopolitical stuff, the reshoring, the nearshoring, the changing in the supply chains, because people don't want such long supply chains now. They want to get them shorter. So whether that's in-continent kind of supply, no pun intended there. So if you're in the States, Mexico or Canada are okay. You don't want in-continent supply, but within a continent supply. So if you're in Mexico or Canada, that's great. Or just in country, which of course is the other one. Of course, if you're Trump, you only want the US to supply the US. That's definitely happening as well. What does that do? It drives capex again. And then infrastructure in the Western world, as we all know, you only have to drive down the road at the moment to know it in the UK, needs huge investment as well. Then you've got the greening of the economy. And I think focusing on those areas means you're focusing in on areas where you've got an underlying investment, underlying increased spending, which then helps any companies exposed to those areas to grow, notwithstanding what's happening within the cyclicality of the global economy. So at least you've got that helping factor behind, particularly in this period at the moment where it's proving very hard really to actually understand exactly what's happening within countries, within consumer spending, within how much they're saving and borrowing, etc.
Yeah, absolutely. So you know, you talked about potentially the sort of rate outlook, the inflation outlook, you know, improving, which may actually come as a tailwind for consumers, particularly you know, if the employment market remains fairly strong. But also, you know, they are hard to read. So is there a case for saying, well, yeah, it might bounce back, but it might not? So perhaps you know, play it safe and avoid those more sort of cyclical areas at the moment.
Well, the UK is interesting at the moment, isn't it? Because as we just talked about the CPI a minute ago, I mean, we had that blip up to 10.4 driven by, in February, which the February number, which was driven by food, clothing, which they do tend to put prices up in February anyway because the new ranges come in, etc., etc. But that OBR forecast and other independent commentators for down to sub 3 by Q4 this year. Well, if we look at that and it rapidly falls back, you know, if you've got inflation below 3, are you still going to have interest rates at 4.25? I suspect not. You might have interest rates at 3.5 in due course. So in that scenario, the UK consumer, if he sees, let's go through how in Q2 it drops to 7 point something. In Q3 it drops to 4.5, and then in Q4 it looks like it's going sub 3. The consumer is going to be going into Christmas, and as you say, we've still got 1.1 million vacancies in the UK. People aren't losing their jobs. The services economy is 80% of the UK economy anyway, so that will help stimulate that whole economy anyway. As inflation falls back, there should be more money out there to being spent. The consumer is going to feel pretty buoyant for Christmas this year, I would say. So that whole area of leisure, retail, travel, assuming we don't get the unemployment, then, and we shouldn't, in that scenario, we shouldn't, then it's quite a good outlook, isn't it, really? But if America sneezes and has a recession, well, that will have an impact around the whole of the world, of course. And that is the difficult thing at the moment. You know, the banks in the US, I mean, there are so many banks in the US. If you look, there's hundreds of them, hundreds. There's mum and pop banks all the way up to the city banks and the Morgan Stanleys of this world. But in those banks which are the smaller banks, where they reduced the oversight of those, that's the issue for the States, that we don't know how bad some of those banks could be. And that's the issue where you've got them talking about potentially extending deposit insurance to protection to the whole of people's deposits, which would be quite be an amazing thing to do if they were to do that, and then would really worry the market if they were to announce that, because everyone would then go, why have they done that? There must be a real problem underlying there that I'm worried about. And the one area that I suppose could be a problem for markets, and that we've identified, and I think other commentators have to a degree as well, is the property market and the refinancing of commercial property and everything there. Because again, this is the end of free money, and what happens when free money ends is that in the public markets, the property companies tend not to be too highly geared. I mean, if you look at the Derwent Londons or the Shaftesbury now taken over by Cameron Counties, but they're in the kind of 20s, their loan to values, LTVs at the moment. But in the private markets, people can gear themselves up to quite a high extent. And these are big funds in the private. And we've seen how some of the funds have been shuttered lately when people have been trying to take money out, because you're dealing with very liquid assets. When they come to refi these properties, and let's say they borrowed when money was zero, and they wouldn't have paid zero, of course, they'd have paid more than zero, but they're going to see a significant increase in their borrowing costs. To the degree that they've geared those funds, or a private company, how much trouble could they get into on that side? And on top of that, with property, you have got in property at the moment, particularly around the world, in the Western world, that the environmental standards that new property has to meet means that actually some properties will become unlettable, because unless you go in and do a major refurb, then they'll be unlettable because you don't meet the new standards in terms of CO2 emissions, etc., from those property. So I think we need to keep an eye on the property markets and what's happening there. And maybe it's more the private side. And that's the unknown about a lot of these smaller banks, because a lot of them have lent a lot of money to property markets. And that's what we need to keep a close eye on, I think, really. Rather than the problem, if there is going to be a problem in the banks, I think it's more going to come from that side rather than anything else.
So some things to keep an eye on, but a generally optimistic tone.
I think so. Yeah. We've gone through what we've gone through. We've got banks going bust now. Credit Suisse becoming part of UBS, but the latest PMIs, we had the flash PMIs last week. The services PMIs were picking up, and for Western economies, the services side of the economy is the major part of the economy, and they picked up quite strongly. So that points to it. And it's confounding some of the thoughts. But while we're still seeing that, I think we have to be confident.
Okay, sounds good to me. Well, who knows? We'll catch up again in another month, and everything could be different again. Well, in fact, almost certainly will. What would be nice? It'd be a nice quiet month, but that seems unlikely.
Okay.
Brilliant. Thanks, Jamie.
Thanks, John. Good to speak.